Welcome to FinBot Insights. Today, we're digging into a question that's on the mind of so many investors. How can you get a piece of the incredible growth from the world's biggest tech companies, but do it without giving up the steady income you might need from your portfolio? And that really is the central challenge, isn't it? We've all seen technology stocks go on these amazing runs, but their incredible success also creates a bit of anxiety. You start to worry, am I buying in at the absolute peak? The fear of trying to time the market perfectly and getting it wrong is a very real concern. For an investor who is focused on generating income, this creates a classic trade-off. It's like a tug of war. On one side, you've got large-cap tech stocks offering that huge growth potential, but they often come with a lot of volatility and pay very little, if anything, in dividends. On the other side, you have your traditional income sectors. Think utilities or consumer staples. They provide those nice, stable dividend yields, but you're typically sacrificing that powerful growth potential. And this brings us right to the heart of what we call the modern investor's dilemma. It is this fundamental challenge of trying to balance your aspirations for growth with your real-world requirements for income. Many people who rely on their portfolios for regular cash flow feel like they're forced to stay on the sidelines when it comes to technology, and that means potentially missing out on one of the biggest wealth creation engines of our economy. So, what if there were a way to bridge that gap? Well, one proposed solution comes in the form of an exchange-traded fund, or ETF. So today, we're going to examine the Kurv Technology Titan Select ETF, which trades under the ticker symbol KQQQ, to understand how it proposes to solve this exact problem. The fund's stated objective is certainly ambitious. It aims to seek maximum total return, which is a combination of both capital appreciation, the stock price going up, and income. It plans to do this by actively managing a concentrated portfolio. Now, that term is key. It means the fund's managers are making high-conviction bets on a relatively small group of top-tier technology companies. Okay, so how exactly does KQQQ try to pull this off? How does it deliver on that dual mandate of growth and income? The strategy is multifaceted, and it really hinges on a combination of how they select securities, how they weight them in the portfolio, and a rather sophisticated option strategy layered on top. Let's break the process down into 3 distinct steps. First, the fund's managers handpick that concentrated portfolio of just 15 to 20 large-cap technology-related companies. Second, they analyze that group and tilt the portfolio, slightly overweighting the stocks that are showing the strongest recent price momentum. Then we get to step 3, and this is the absolute key to the income part of the equation. The fund writes covered call options on its holdings to generate a premium. Now, that covered call strategy is really the income engine for the entire fund. Let's quickly define what that is. In simple terms, because the fund already owns shares of a stock, that's the covered part, it sells a call option against those shares. This gives another investor the right, but not the obligation, to buy those shares at a preset price in the future. For selling this option, the fund receives a cash payment, known as a premium, which it can then distribute as income to its shareholders. So now that we understand the mechanics of the strategy, let's pop the hood and take a look at the fund's actual holdings and a key distribution metric that comes out of this process. This will give us a much clearer picture of what you actually own and what you might receive as an investor. You can see right away what they mean by concentrated. The top 5 equity holdings represent a very significant slice of the total portfolio. But of course, that's entirely by design. It reflects that high-conviction approach. The names themselves are exactly who you'd expect to see in a technology titans fund. Now, one interesting detail about these holdings is the flexibility that active management provides. For example, the fund can hold a company like Amazon, which is technically classified in the consumer sector, not technology. It's not restricted to a specific index like the NASDAQ 100. This gives the managers the discretion to select what they believe are the truly preeminent technology-related firms, regardless of their official GICS classification. And this brings us to a figure that is absolutely central to this fund's appeal for income investors, a 9.04% stated monthly distribution rate. Now, it is critical to understand what this number represents. It is the annualized yield an investor would get if the fund's most recent monthly distribution remained constant for a full year. It does not represent the fund's total return, and it is not a guarantee for future payment. Of course, no investment analysis is complete without a disciplined and honest look at the risks involved. It is absolutely essential for any potential investor to understand the warnings that are detailed right in the fund's own prospectus. First, there are the general risks. Because the fund is non-diversified, a negative event at just one of its large holdings can have an outsized impact on performance. Its value is, of course, very closely tied to the fortunes of the technology sector as a whole. As an actively managed fund, there's always the risk that the portfolio manager's decisions may not produce the results you hope for. And finally, like any ETF, it has its own specific risks, like liquidity and the potential for its market price to differ from its underlying asset value. And crucially, the option strategy itself introduces its own very specific trade-offs. You know the saying, there's no such thing as a free lunch. By selling those covered calls, the fund caps its participation in a stock's potential upside. If a stock it holds goes on a massive tear, the fund will not capture all of those gains. The monthly distributions are not guaranteed, their amounts can and do vary, and they may sometimes include a return of capital, which is essentially the fund giving you your own money back, which reduces its net asset value over time. All right, so having reviewed the strategy, the holdings, and the inherent risks, we can now synthesize everything down to the core proposition of the KQQQ ETF. Let's bring together its approach to growth, income, and risk management. This quote really does perfectly encapsulate the fund's central premise. The proposition is that an investor no longer needs to make a binary choice between getting exposure to high-growth technology companies and receiving a regular income stream. This fund is structured to try and deliver both. This all leads us to the final and most critical question, and it's one that only you can answer. After considering the potential for growth, the mechanism for generating income, and all of the inherent risks and trade-offs, does this specific investment recipe align with your personal financial objectives, your time horizon, and your own tolerance for risk? We hope this breakdown from Finbot Insights has been informative and has given you a solid framework for your own research. If you found this analysis valuable, we would really appreciate it if you'd like this explainer and subscribe to our channel for more data-driven insights on financial products and market trends. Thank you for watching.